Folks, I hope you are ready for some fireworks. I took a shot across the bow on Saturday, or might have been Friday. I took a shot at my weekly guest, Taylor from Life Goal Investments. He put out a Instagram post where he was ranting about the idea that most millionaires are created in a recession. So let's welcome Taylor to the show. Let's allow him to set his position because I'm not sure everybody saw it. And then he and I are going to talk about it because I have told you many times that wealth is made in a recession. So Taylor, I want to turn over the floor is yours. What set what set you off? Because I love it. First off, when you rant, you just go for it. I appreciate it. But the floor is yours. Tell me tell me why you are so frustrated by this.
I have seen on countless pages, social media websites, etc., that most millionaires are made during a recession. And these are investing focused pages as well. And so the one thing, this just seems like this mythical creature of a recession. And if you capture it, it is going to be the greatest thing of wealth creation that you've ever seen. So much money changes hands on down the line. And just none of the data from an investment standpoint backs that up at all. And they don't say anything about data or numbers. They just lay that out there and they say, just trust me. And so I say, I don't do that. I don't make narratives. I follow data. And so to start, when it comes to recession, you have to realize that most of the time that we're in a recession, 50% of the time, you don't even realize you're in a recession. So like I looked at the last 6 recessions, going back over the last 6 recessions, the end date of the recession actually came prior to the announcement of a recession being in place.
Good old Economic Bureau of Statistics, right?
Right,
Like,
exactly.
we call it late.
So to be clear, you don't know you're in a recession until you've already been in a recession. And it's funny that the National Bureau of Economic Research, the NBER, Michael was just referencing there, they're the one that announce it. And there's no hard and fast data that says, hey, if this happens, we declare a recession. There's 5 or 6 points. They're all very squishy, if you will, and they manage them the way they want. And I'm sure they get pressure out of Washington to have folks say, hey, we're not in a recession right now. We don't want that on our clock, et cetera. But at the end of the day, when you look at investments, and most of the folks that talk about this great wealth transfer and everyone making so much money during a recession are talking about investing in the S&P 500. So when you look at a recession, this is probably where we're going to differ here. Right. But let me play this out a little further.
Please.
The average recession, if you look at the last 12 of them, that's what takes you back to World War II, the first one being in 1948, the last one being COVID. The average recession lasts just over 10 months. But they've been as short as the COVID recession, which was 2 months long, and as long as the great financial crisis of 18 months long. And the average drawdown the S&P 500 experiences is 30%. So if you're telling me that people get wealthy during recessions investing in the S&P 500, that's not how I define getting wealthy, losing 30% of my value. And so when you look at the dates from the start to the trough, generally it lasts about 7 months into the recession. You hit a bottoming point, and then you do hit an inflection point because the market is a leading economic indicator, sees the end of recession, and does bounce back upwards. And you generally get about a 3-month exit into the recession of a positive market. So at the end of the day, what my whole thesis on investing in general is for folks that aren't doing serious fundamental research into companies is diversify. Don't just buy the S&P 500 and take it 30% on the chin in the drawdown. Buy some bonds, buy some gold that both have historically gone up, appreciated in value during recessions to offset your S&P 500 that's down 30%. So let me shut up, but I was frustrated, so I ranted. There you go.
No, I think that is wonderful. And again, I wanted you to do that because I think people see the passion in this. So let me kind of summarize what I think you said in my words. So obviously you've been highly educated in finances. You were on Wall Street for 10 years. You created diversification plans for the wealthiest people around. That's your area. So because that's your area, your feeds are very stock oriented, S&P 500. And again, these are my words. They're not yours. So if anybody doesn't like them, they're mine, not his. Basically, the S&P 500 probably showing stress on volume. Right? People are probably not, in a recession, consumers get scared. So they're trying to create a narrative that basically says, hey, buy the S&P 500, buy it at a discount, hold on to it. And you're basically saying the numbers don't say that. You're asking people to dollar cost average, into what might be a 30% decline, historically speaking. So I think that's what you're kind of highlighting.
Correct. And I'm also saying when you dollar cost average, say you've done it over 30 years, you have 30 years of money going into that recession that you're going to dollar cost average down into in an S&P 500, which is what they're telling you to do. I would rather not have that 30-year nest egg that I have taking it on the chin at 30% as I dollar cost average into the downside. What I want to do is diversify. And so once you diversify, then your downside is muted. Say it's down 10%, down 8%, depending on your asset allocation. And then when you start to see the kind of other side of the light out of the end of the tunnel coming, then maybe you start to rotate back into more aggressive risk on assets, like investing in the S&P 500. And then all of a sudden you go from being down 30 to being down 8 and still capturing most of the upside on the other side that these people are talking about.
Yeah, the diversification. This is, again, what you were essentially paid to do for a decade, right? Working with the folks, creating that all-weather portfolio, all those things.
Thing. People have to realize how wealthy people invest. Wealthy people see this as a game of, let me slowly grind out returns over time. Maybe I don't capture all of the upside, but remember, if you lose 50% on the downside, you have to get 100% back. So what they're saying is, let me limit the downside, and then I don't have to get as much of the upside on the other end. And let's not forget that also what happens with people on the downside is they go, oh no, I'm scared, I'm leaving. And then the upside is not
experienced. They recognize the loss and don't catch the upside, right?
Exactly right.
Yeah. So this is a really interesting conversation because, again, something I've been putting out for 6 or 9 months, maybe even a year now, is that wealth is created in a recession. Now, obviously, I am definitely more real estate focused, not stock focused, without question. You are here to help balance me out, help me, help me get better, frankly. But yeah, I still stand by that. I think real wealth is created in a recession. I think saying most millionaires are created in a recession is, unprovable, frankly, and probably illogical, because recessions are 10 months and, boom times are 12 years, right? So, I mean, mathematically speaking, it doesn't make logical sense.
That's a really good point.
Yeah. But that said, I do think wealth is made in a recession, at least in real estate. It's slower moving. You can have unfair advantages, right? You can create value or find value in unique ways. It's not as an efficient market as trading. And I do have evidence, right? We have housing and real estate recessions, the greatest one being the great financial crisis, which, if people read my book, One Rental at a Time, there were 3 or 4 moves we made that took us from very little to, more than we need. But I think the greatest example of a real estate investor just doing it right was Sam Zell in the S&L crisis, right? He went from, somebody running student housing to the largest real estate operator on the planet, at least for a time, both in commercial and residential. So I think real estate is a place to build wealth in a recession because it's inefficient, because it is slower moving. That's kind of what set me off in your rant. I was like, dude, Taylor, get out of your head. This is not all about S&P and gold, right? There's this other asset called freaking real estate, and you can make moves in a recession. So that's what I was thinking.
I think when it comes to my end of it, I think what I was trying to have people realize is that during recessions, it's more about maintaining wealth than it is garnering wealth. And what you do there is you separate yourself from the masses. Yes. So everyone, maybe I'll put it differently and say this way, and you can refute my words if you want. Everyone loses money during a recession. What you want to do is lose less, so the purchasing power of your dollar can be bought with someone that is hurting a little bit more than you. And so you can take that asset out from them because they need the capital. So you need to have the accessibility to dry powder, whether you're investing in real estate or whether you're reinvesting into the stock market. You need that dry powder that's maintained its purchasing power and not gotten whacked by 30% or whatever it is, to then deliver on the other end to make you a millionaire coming out of the recession.
Exactly. Yeah, I would agree with that. I mean, again, the other thing about recessions, and we treat this like a boogeyman, they're part of the business cycle.
Correct.
Right. Right. You're a young man. You probably are going to see 4, 5, perhaps 6 recessions, meaningful recessions in your lifetime. And generally speaking, with the COVID one being kind of the one, exception, I think, is they don't come out of right field or left field or whatever.
Correct.
Right there, you can kind of see them coming. Right. This was probably the recession that's been most called for coming. But all of them were, right? You could see the cracks kind of build. And that's why when you look at economic data, you can be like, oh, wow, the consumer just changed, or, earnings been down, we're in an earnings recession now. And if we have a, S&P 200 and the multiple is, 20, it should be 16. And you can kind of see them coming.
Correct. And you just made a really good point there. You said that, oh boy, fleeting thought, should have wrote it down. We'll get back to it. You made a great point there. I'll give you that.
There you go. Well, I actually want to go on to my idea of building wealth in a recession. We're going to make that a second video because I think building wealth boils down to 3 points. But folks, if you want to see Taylor rant, and he does videos every day, they're always educational, they're always fun, but about 2 or 3 times a week, you can tell he gets hot under the collar. Where should people follow you?
Follow us at Life Goal Investments. We're on both Instagram and TikTok. I appreciate you, Michael. You're the best.
Thank you, buddy.